All right, everyone. A very good evening once again. I hope you all are having a great day. Correct. So today's the third live streaming session, and like we say, during the third live streaming session, we will be talking more about education. Correct, education pertaining to technical analysis. Now, let me start this live streaming session by giving a quick introduction about the one and only Harsh. I am Harsh. I have 8 years of trading experience. Correct. I have been trading the forex markets, sorry, the commodity markets such as gold, oil, silver. I have been trading the US indices such as the S&P 500, the Dow Jones 30, and the Nasdaq 100. Currently, we are also analyzing the Indian share market where we analyze the indices such as Nifty and Sensex, as well as determine trading opportunities in various individual Indian stocks as well. So I am more of a technical trader specializing in technical analysis such as supply and demand, price action, order flow analysis, swing analysis, Fibonacci retracement analysis, and so on. The list is quite exhaustive, but these are the major aspects when it comes to technical analysis. I have been blessed and I have been guided by some of the best minds in the financial industry. I have been able to receive the opportunity to be trained under some of the best flow traders who have worked on the Chicago Mercantile Exchange. So these people with who were on the floor trading when the real markets were physical, back in the days, shouting and selling, buy, sell. So I have been blessed and I have had the privilege to be mentored by such intelligent and loving people. I have also been able to successfully manage around $20 million worth of portfolios and have been able to generate a profitability around 30 to 35% on an annual basis. So I hope everyone understands with these live streaming sessions, they are taken care or they are provided by some of the best people in terms of qualification, in terms of experience, and in terms of knowledge. So you can be well and rest assured that yes, you are, getting knowledge from someone who has experience, who has been exposed to the financial markets considerably. Correct. Now, let's start with today's third live streaming session where we would be focusing more on technical analysis. Correct? That is where I specialize in providing education based on technical analysis. Let me talk a little bit about dolphin markets. Dolphin markets and Harsh are here to provide you with top notch A1 quality content, right? Content in terms of analysis, in terms of trading opportunities, right? When the stock market is open from 9:15 a.m. Indian Standard Time all the way till 3:30 in a PM Indian Standard Time. During that time, we provide you with trading opportunities, right? Opportunities to make you money, and we also provide you with education. This particular live streaming session, the third live streaming session that takes place, is generally, focused towards providing you with vital information when it comes to technical analysis. So you understand how the entire system works. In the first two live streaming sessions, you get the opportunity to make money, right? By us providing you with trading opportunities. In the third live streaming session, we provide you with education. So that is where you learn. And when you combine the two, you can learn and earn, correct, at the same time. So that is the entire motto of how dolphin markets have been performing. We have been showcasing our potential in terms of our profitability, right? When it comes to, do not worry, we would be ultimately be talking about technical analysis, but a quick overview for people who are new and who wants to understand what dolphin markets are all about. what Harsh is all about, right? What these live streaming sessions are all about. So we are here with the main aim of showcasing our profitability in terms of taking trades consistently and booking profits consistently, right? As you can see, from the 18th of September all the way till 7th of November, we have been, taking trades, recommending trades to the public, and consistently booking profits as well over a span of less than 2 months, correct? We have been able to take trades on around 34 different stocks, and we have been able to generate a cumulative profitability of around 135%. Correct? That is insane. With the average profitability per stock or per trade to be around 5%. During our time, during our analysis of the market conditions, we have understood that rather than letting price run further to bigger targets, we want to capitalize on targets consistently. And the 5% profit target is a very great value in terms of markets moving and making money consistently, right? We do not want to take one or two trades and make 10 to 15% profitability, because the chances for price to do that reduces significantly. So we want to take trades and generate consistent profits, correct, on a regular basis. So we have our stock tracking that showcases the entire, detailed and descriptive analysis when it comes to showcasing where the trades were taken, on what date the trades were taken, the name of the stock on which the trade was taken, the time at which the trade was taken, the entry level, and once the price is coming closer to target, we also mention the day at which the trade was closed, the value or the price level at which the trade was closed, as well as the profit made for that particular trade. So there is a complete and open, book for everyone to see that yes, as and how we are, as and how the days are progressing, as and how we are coming with certain trading opportunities that we are providing to our beautiful community members, we have been, recording it and maintaining it diligently, and the results are speaking for themselves. Having said that, we also have trades that are running since the market is full of uncertainties, and we trade based on probabilities, right? The market runs on probabilities and not certainty. So there are certain reasons or certain trades that have been going, that we had provided to you, but unfortunately they have been going against. But nonetheless, like I say, when Harsh is here, there is nothing to fear. As in how the market conditions are improving and improvising, we will update you with the necessary instructions that need to be followed. All right, enough with all the stock tracking and stock holding. Let us talk about today's session, right? We're going to focus on technical analysis, and that to not beginner, not mid-level, but advanced technical analysis. All right. So we are going to be focusing on the two biggest, market players when it comes to technical analysis in terms of FIIs and DIIs. I'm pretty sure a lot of you people would be aware of the of the terminology of FII and DII. So let us have a quick look at what FIIs are. As you can see, FIIs are foreign institutional investors who are residing in India but are not a part of India. These are referred to as FIs, and they can be mutual funds, insurance businesses, etc. Or examples are JP Morgan, Morgan Stanley. So you get the point. These are foreign companies that have established their branches in India. So the parent company is not from India, and they basically have their headquarters situated outside India, correct? So these are FIIs. These are international companies. Then we have DIIs. So DIIs are domestic institutional investors who want to profit by putting their money in the local market, right? In the Indian stock market. So the DIIs can put their money, can put their capital in insurance companies, mutual funds, liquid funds, and other investments. So these are some of the, examples of GI, like we have ICICI Prudential, we have Nippon, we have HDFC. So these are local companies, right, investing in the local stock market. So these are DIIs, or domestic institutional investors. A quick look in terms of what is the, some of the differences, right, between the FIIs and the DIIs. We've got location. So, of course, like I told you, FIIs are abroad, are basically based abroad, and DIIs are the local based, right, England based institution investors. So, location, then we have limitations in terms of the real amount. FIIs can only invest up to 24% of the total amount of companies' paid up capital, while there is no such restriction for DIIs and research teams. Since FIs are not natives of the country where they are investing, they must undertake additional and more in-depth analysis before making investments. Correct? Since they are basically foreign companies, so they need to have more knowledge of the local markets, stock market holdings. FIIs hold approximately 21% of overall holdings in the company that make up the Nifty 500, right? On the other hand, DIIs hold about 14% of all the shares in the Nifty 500 companies. So this shows that the percentage, the heavyweights are the FIIs, correct? And investing style, foreign institutional investors invest with a focus on the short to medium term. Domestic institutional investors invest mainly for the long term. This is a major reason and a very important point to keep in mind. As you are aware, in the current market scenario that has been taking place all the way from the end of September, mainly from October, is when we have been seeing a huge correction, right, in the Indian economy, especially in Nifty 50 and Sensex. So that is the one of the reasons, right? One of the main reasons for such a correction taking place in the Indian indices is because the FIIs are pulling out funds from the Indian economy and are investing it into other economies where they are getting better investment growth rates, correct? Such as China. China is adding a lot of stimulus into their economy in terms of attracting foreign investors, and also in USA, right? When Mr. Donald Trump has won the US election, there was an outburst of optimism in the US economy, and thereby the US economy has gathered a lot of bullish strength, right? But people have to understand that the FIIs are looking for short to mid-term. They are not bothered what will happen in the next 10, 20, 30, 40, 50. Yes, they might have an idea or an estimation as to what they would be expecting, but when it comes to, investing, they are investing with the sole purpose of investing it for a short term to mid term. But on the other hand, we have the domestic institutional investors. These are local investors, and they understand that yes, the country, the need to support the economy of the country they reside in, and they believe that yeah, there might be corrections taking place, but overall, the country is doing very well economically, financially, and politically, and their mode of investment is for the long term, right? 20 years, 30 years, so on and so forth. So now the other main topic when it comes to advanced technical analysis is stop loss hunting. I'm pretty sure every one of you who are attending these live streaming sessions at some point in time would have been stopped out, correct? We place a trade, we expect the trade to do what it should be doing, like in terms of going in our favor and hitting our take profit, right, where we can make money. But sometimes the markets do not listen to us, and they do, by going against our direction and then stopping us out, only to continue to return back to the same direction. So let us look at some of what is stop loss hunting, and how do how do people, or how do these institutions, because the reason we have been talking about FIIs and DIIs are, these are the big market makers, right, in the Indian share market. So they are the ones who are injecting funds injecting capital, and they're the ones who are pulling out the capital as well. So they are the ones who are responsible for the fluctuations in the Indian share market, and that is why we need to focus on how they perform, how they take trades, and we will be talking more in detail. All right. So coming back to the stop loss hunting, a quick definition: stop loss hunting is a type of trading strategy that aims to profit by deliberately triggering other traders' stop losses. I hope everyone is aware of how the stock market functions, right? What comes in has to go out. The stock market is like a valve. There is only one entry and one exit. Whoever makes money, someone else is losing money. If someone else is losing money, some other person is making money. It's a zero sum game, correct? So that is the reason why this is of vital importance when it comes to stop loss hunting strategy, right? So how do you hunt for stop losses? The concept behind stop hunting is pretty simple. So there are four ways. So key technical levels. People are clear about certain technical levels like support and resistance. Let us read. Attempt to figure out where stop losses may be concentrated based on support and resistance or key chart pattern levels. We will talk more about in detail on the charts as well. Then order flow. Look at the order volume to determine where stops may be concentrated. Large orders indicate the possibility of large stop loss accumulation. Depth of market for ultra short term trades, DOM, depth of market can help you figure where stop losses are likely accumulating. And sentiment and news analysis for stock concentrations among investors. Monitor the news and any market moving economic release. If a news release garners significant response from the market, try to determine where larger investors are placing their stop loss. So these are some of the key points to keep in mind in terms of how the markets behave. Why do people get stopped out only for the prices to return back to their favor? So we will look at it from some of the charting examples, correct? So this is a chart of the micro S&P. Now it doesn't make a difference whether you're looking at whether it is a US stock or an Indian stock or a UK stock. We are looking at it from a technical analysis point of view, correct? So just focus on what is being depicted in the chart, irrespective of whatever the ticker symbol, right, is. So, for example, what this illustration depicts is we had an entry at around 3904. Prices had entered at 3904 and prices had started to go in that direction, only for prices to come out, and the blue color line signifies where we had placed our stop loss. So, this is just a depiction, an illustration in terms of how prices return back to our entries and sometimes even stop us out, and that creates panic, that creates animosity between traders and investors, and eventually the price goes into our desired direction but after stopping us out, correct? Another kind of market manipulation, I'm very sure people would be using trend lines, correct? So we have a trend line drawn, as you can see. The markets have been testing, so the upper trend line is acting as a resistance and the lower trend line is acting as a support. So when prices are oscillating between the two trend lines, the prices are holding, right? We had a manipulation at point number 4, as you can see. There is a reason why prices reacted from 1, 2, and 3, but not at 4, because people were anticipating if price has tested the resistance once, has tested it twice, and tested it thrice. The fourth time it should hold, right? That is the general consensus when it comes to support and resistance. But as you can see, prices had stopped people out only for prices to go back into the same direction. So price created what is called as manipulation, right? Manipulation is nothing but certain areas on the price charts where prices should have performed in a particular way, but they did not, right? They overstepped, or they went over the margin and then they reversed. So this is a very clear depiction of what a manipulation looks like, correct? Similarly, let us see some other examples. So this is basically what is called as market manipulation. Market manipulation is the attempt to artificially increase or decrease the price of a security. It is artificial because the manipulator is attempting to skew, right? To skew supply and demand to push price in a favorable direction for them. Skew is attempting to skew is to distort the picture that is being actually provided, right? So the meaning of skew is to distort. Looking at this particular example, let us understand how a typical trader, or an analyst who is looking at charts is trying to identify certain levels. So for example, we do understand that prices had come to an area of resistance and reacted well. So the next time when prices come back to the same area, what would the general consensus think? Yes, since it is approached an area of resistance, we would expect prices to be pushed down. As you can see, the prices had also started to push down from the area of resistance. But then you can see the prices are again returning back to the area of resistance. And that is the time when sellers are placing their short orders, because as and how the trend line or the channel is being tested multiple times, it increases the confidence level, it increases the probability of that trend line or channel to hold price. In this case, we are talking about resistance. So since prices had tested it once and twice and thrice, the fourth time people are more confident that it should be holding. But unfortunately, prices are closing and shooting above, right? So you can see that sellers close positions in loss, and at the same time, we have people who trade support and resistance, and we also have people who trade breakouts, correct? So for people who understood that the last resistance has been taken out, we have breakout traders coming into place, and that is where the moment price closes outside, people want to buy. For those people, they get stopped out as well, right? This is a very clear and descriptive illustration when it comes to market manipulation. Prices which were holding at resistance did eventually hold initially, but then prices reversed and stopped out, right? So the moment prices closed above the resistance, we had breakout traders who were looking for opportunities to take long, because now that the resistance is broken, the resistance should act as a support, right? We had discussed it in yesterday's third live streaming session, where we were talking about support, resistance, and flip zones, where a previous support which is taken out becomes a resistance, and a previous resistance that gets taken out gets converted to a support. So these are called as flip zone. So both ways, people who had taken the trade based on the resistance got stopped out, and people who entered based on the breakout strategy had also been stopped out. This is a very clear example of market manipulation. Let us look at some other example based on the same market manipulation. As you can see, we had a resistance, and prices had been holding resistance for once, twice, thrice, right? The fourth time prices closed out, people were like, okay, now this could be a breakout trade, right? Moment a resistance is taken out by a candle closing outside that particular resistance area, it gets converted, or it is the term used is called as breakout. So prices closed outside and prices started to go sideways, right? Prices started to consolidate. Once the prices started to consolidate, you can see that the prices consolidated and started to again close inside the resistance, right? So now people are indecisive, people are skeptical. What is price trying to show? And for this particular example that you are seeing is gold, right? I know a lot of you people trade gold, so these are real based examples, right? So prices close outside, taking out resistance, then prices are closing back inside, indicating bearish pressure. So now there is bullish pressure and bearish, there is bullish sentiment and bearish sentiment. Eventually, the prices are, creating a bearish engulfing pattern, and prices start to continue down. So it is important to understand when it comes to such market manipulations, the markets will have manipulations, right? Because the market is a zero sum game. What comes in has to go out, all right? If someone is winning, someone is losing. If someone is losing, someone is making, someone is winning. Let us look at some of the charts and try to understand from a real time basis, right? Let us pick some trades which we haven't looked at. So let's look at, okay, let's look at VBox. I mean, B-Box was one of those trade ideas which was provided to you on 17th. And look at the way it hit the 5% target, it hit the first target, and it hit the second target. Yes, we did come out at 5%. I clearly remember, but we are just trying to showcase that sometimes trades work pretty well, right? Almost an appreciation of 25%. Like, that is huge, correct? When it comes to such potentials, profitability potential. All right, now we're talking from a technical perspective. So let me give you examples of real time, right? So as you can see, when people are talking about, manipulations, let me search for a clear example. Typically, when we are looking at manipulations, we mainly focus on only two types of traders, right? Traders who are using support and resistance. All right. So, people who are using support and resistance, and people who are using, breakout traders, correct? So let me give you an example. As you can see, this is a clear depiction where prices have been bouncing or oscillating. Let me change the color because generally the color red signifies losses, right? So I don't want to scare, I don't want anyone to panic, so I would make sure to change the color to maybe orange, right? So orange looks better. All right. So in a general market scenario, you can see that prices are clearly holding the resistance and support, right? Whenever prices are reacting to resistance, they get pushed lower. Whenever prices come to support, they hold properly, right? Now a typical manipulation looks somewhat like this, where you have prices which are, you know, which have shown that yes, this support area, let me mark it first. So this is support. One second. And this is resistance, right? So since prices have been playing quite fairly between support and resistance, the prices have been oscillating between the two, between the floor and ceiling, between support and resistance, and eventually there has been a breakout of price, right? So the moment the support gets taken out, right? Let me mark it with um, okay, leave it. So, anyways, so as you can see, the moment the prices get taken out, this is where we would have people who are, following breakout strategies. We call them as breakout traders, right? So, the price creates a breakout. The moment the price creates a breakout, we have people who are interested or who are analyzing the markets, and they are like, look, Harsh, now we have seen that there has been a breakout in terms of the last support which was holding, you know which was holding once, twice, thrice, four times the support has been holding. Eventually, fifth time price came in and then it created a breakout. For people who saw this as an opportunity to enter based on breakout strategy, they have taken their shots, correct? So people have started to enter shots in that particular area only for them to get stopped out again, right? Because prices start to do what? Prices after breaking that support area, and once prices close outside, this is a clear depiction which we call as manipulation, right? So the breakout for people who entered is basically nothing but manipulation eventually, right? Because prices start to go sideways, right? Prices start to go sideways, so we have like a channel that is being created, right? Prices start to go sideways, and then we can see that for people who had taken shots over here are already panicking because the prices are returning back. Now people are like, okay, then it again came, it's come back to support, the previous support that was holding. So people who entered on breakout, who had understood that, okay, once the support gets taken out, it creates a resistance, right? So a previous support becomes resistance. Those are called as flip zones. And prices have been sitting over there only for prices to again return back. So the people who had entered based on breakout strategies have entered and have already panicking or are stopped out. People who again thought that yes, now the support which was previously holding is again getting initiated, or it's getting activated again. People started to go long, and that is how manipulations take place. So we had manipulation number one, over here, and we had a manipulation number two over here as well. I hope people are able to get a clear idea when it comes to such kind of manipulations. And remember, the stock market is known for manipulation, right? Not just the stock market, we are talking about the financial markets in general. There is only a one way in and a one way out scenario when it comes to the financial markets. What comes in has to get out. It's like a valve. There are no other options of exit or entry. So if someone is making, someone is losing, and if someone is losing, someone is making. Eventually we could see prices created manipulation number one, manipulation number two, and as well as manipulation number three, correct? So for people who think that shouldn't the markets follow exactly the strategies that are written in the textbook, unfortunately the answer is no, because what we learned in our textbooks, right? When I was a student myself, we were provided with vital information about support, resistance, breakouts, but does it exactly happen in practical life? Not at all, right? The markets keep changing, the markets are fluctuative. So that is the reason, rather than having a clear hypothetical example where we had support holding once and twice, did it hold eventually? Yes, right? If you could see, the resistance is holding quite well as the support. But once the breakout takes place, that signifies, okay, now the support is taken out. Now it's the time to enter short. For people who entered short, they started to panic the moment prices closed above the support. We had people who had taken short, they got stopped out. Now people who had already taken long on the based on the previous support, they entered again long. Those people were making, okay, good amount of money, but eventually the prices reversed again. So these are manipulations that take place, right? Now again, we have people who would be looking for breakout trades. People would consider this to be like a channel or some sort of indication that yes, now prices have broken out, prices should continue. They do eventually, but only to get reversed again. So the markets sometimes, or not sometimes, most of the time are quite obnoxious when it comes to what decision, which direction the markets have to go, and these are called as manipulation. These can only be done by heavyweights of the markets, right? Who are the heavyweights? The FIIs and the DIIs. So I might be getting a question in terms of, so are you telling me that the FIIs and DIIs are flushing in all the time and flushing out all the time? No, they need to place levels in quantities, right? They can't flush in. They have billions and billions of dollars worth of capital. Does that mean that they put in all the money all at once in one particular stock? Not at all, not possible. There are very strict rules and regulations in terms of what is the size an FII can invest in or put money in, what is the percentage, how what is the quantity of trades that they can play with. So the rules are quite strict and stringent, so they have to place it in batches, right? In batches they have to place their trades. But nonetheless, this is how manipulations take place, where a previous support has been taken out, breakout traders enter, they get stopped out. The people who believed in support and resistance again enter, they get stopped out. The breakout traders again enter, they get stopped out, and eventually the prices start to um, continue back in the movement that they were previously continuing. that is this particular direction. So this is the overall, context when it comes to what market manipulation is all about. I hope people are able to understand market manipulations are, there is no way in terms of avoiding market manipulations, but with, confluence, the word is confluence. If you can get the fundamental and the technical aspects of trading together, right, you can increase the probability of, making money in trades. And we have been doing that quite consistently, right? The numbers do not lie. We have been consistently delivering good amount of profitability rates over a span of 2 months on a sample size of almost 30 plus, right? 34 to be precise, and been able to generate a overall accumulative profitability of 135%. This is how we showcase you the power that Harsh and Dolphin markets are able to provide to you, correct? Such trades which are, important to understand in terms of certain terminologies or concepts when it comes to advanced technical analysis. Many people, they prefer or they get satisfied just using the mid to basic level technical analysis, such as support, resistance, maybe MACD, or moving average, or parabolic SAR, or RSI, or super trend. I mean, there are so many, right? The moment you click on indicator, you have a list of indicators that are never ending. They are exhaustive. Based on that, people think that we have learned quite enough. No, that is not just enough. You really have to understand how the FIIs or the DIIs are placing orders. Now, people would be asking, how would you know where they are placing orders? That is where you would have to do a complete detailed analysis, right? You would have to understand where are the people who are, planning to enter, because majority of the time the market will go against them. How to enter? Then we use certain tools such as Fibonacci, where I had already discussed. If you look at a previous high, if you draw a Fibonacci from the previous high to the previous low, right, we are considering this as the high and this as the low. You can clearly see that prices had come to a very important area of a fib number, which is called as 61.8, and prices had started to retrace. So there are many factors which come into consideration, correct? We cannot be taking trades just based on one or two factors. The more positive factors that are, in your favor, the higher the probability for the trade to go in your direction. um, let us return back to the PowerPoint, because there are certain points which have to be covered as well. Because when it comes to trading, yes, learning is important, and understanding how the markets function is also important, right? So, some of the key points to remember when it comes to trading: understand the market before you start trading. Very important. A lot of you people out there, they believe that just because you have learned something about trading in 1 or 2 days, you become a qualified trader. That is not correct. You need to put in the time, energy, and effort. There are traders out there who have been trading for years but are still not consistent. Why? Because they haven't, corrected their foundation. It's very important to focus on foundations. Without focusing on the main base, the foundation of your trading education, it is, very hard to have a successful trading journey, correct? So some of the key points here to understand are understanding the market, right? So we have market terminology, the factors which are influencing price movements, whether that is fundamental, technical, geopolitical, the unique traits of the market, and they combine together to create an educated trading. They lead to having educated trading decisions. The more factors that you can combine in, and the more consensus that you can generate, the better the probability of making decisions, correct? You have to determine the market conditions not just from a technical or fundamental. You should always combine the two. There is a huge dispute that keeps going on between fundamentalists and technicalists, correct? So we are talking about fundamental analysts and technical analysts. Fundamental analysts are only looking at balance sheet, cash flows, right? Income statement. So they look at numbers and they crunch numbers to understand how well a company is performing, right? What are the numbers that are suggesting that the company will do better in the future? On the other hand, we have technical analysis, right? Technical analysis are looking only at price charts, right? I am more of a technical analyst, so I can talk more about it, correct? So we look at mainly price charts because we believe that the market, the price is king. Whatever is showcased on a chart, right? Whatever you are seeing on the chart is already factoring into consideration everything that has been taken into account. So we believe that whatever is being showcasing on the chart is what is present, right? And if something has happened in the past, if a structure is has been created in the past, the probability for a similar structure to be created in the future is also of high probability. So we based on technical analysis, we figured out which are the places where we would like to enter and where we would expect the price to hit our target to. But having said that, it is still crucial to understand that to be better or to get higher probability trades, you need to have fundamental analysis and you need to have technical analysis together, right? The best of both worlds. Then we are talking about risk appetite. It is of crucial importance, right? Because many people, many investors, many traders, they oversee this crucial aspect. When you are looking at trading, it is very important to understand that trading is based on probabilities. Trading is not based on certainties, correct? We can only be probabilistic of a particular scenario taking place in the future. Take for example, you yourself do not know what you will be doing, evening or the next day or the next week. There might be changes coming in just because you thought it has to function in a particular way, not necessarily has to function, right? Especially in the financial market. The markets are dynamic. They can go either way. They can be bullish, they can be bearish, or they can be neutral. So we are doing our due diligence in terms of analyzing, based on financial fundamental analysis and based on technical analysis. But even after all the due diligence, after thorough analysis, we can still be on the wrong side of the trade. So it is very important to make sure that you assess your risk appetite, right? People who want to go with a lower risk should position size with a smaller value. People who think that no, we want to go moderately risking, you can moderate a little, higher value. And people who think that okay, I know this is for certain, I know this trade will do best, and they want to go with high risk, the choice is yours. But ultimately, please be aware that the markets are dynamic and the markets can do what they want to do, and the markets run on probabilities and not on certainties, all right? Then the next fourth point is understanding about risk to reward, right? Now, this is a very important concept where people often oversee. How much are you risking in terms of how much you are able to generate profits, right? So, the bigger the risk to reward, the better the trading, right? The less risk to reward, the less, significant trading will be. Then we are looking at trading plan. Another crucial important aspect when it comes to trading, but a lot of people oversee this too. People think that just because I know how to trade, just because I'm clear in terms of analyzing the markets and speculating what the markets are going to do, that is not sufficient. You need to have a detailed trading plan. You should be knowing what to do, how to do, and what to expect, and whether the expectation is in your favor or against your favor. Every trade taken should be, methodically be logged or should be journaled. We call it as a trading journal. So it should be journaled properly. It should be mentioning the date, the time, the price, like the way we do, correct? I hope people can see my screen. We maintain a very detailed analysis when it comes to, this is just the numerical value when it comes to the numbers showcasing the profitability, but we would also suggest in terms of how you were feeling when you had taken the trade, how optimistic you were, certain emotions, or how pessimistic or how uncertain you were when you were taking a trade. These all factors help into taking consideration as to what your personality is when it comes to taking trades, or how well you are able to adapt to the changing market conditions, as well as what should be done in case the trade does not go in your favor. So these are very crucial points that are to be paid attention to. A very simple plan, a very simple example to talk about is a commercial pilot, right? Commercial pilot, people who fly commercial flights, right? I hope everyone has traveled once or twice in their life, right? So when a pilot flies, he doesn't just learn it from YouTube or Google, correct? He goes to a flight school. He has to learn the instructions, the information that is being provided. He has to, take tests. He has to pass those tests. And only after passing tests and, gaining good amount of experience can he become a pilot. A pilot, a person who is qualified to fly a plane. Now, once they become a pilot and they are, getting ready for takeoff, they have a checklist. Without the checklist, without making sure that each and every variable is not, left undone, they cannot take off, right? So similarly, when you are taking trades, when you are, understanding how, when you want to become a better trader, it is very crucial to maintain and journal what is your mood, where you plan to enter, what do you expect the markets to do, and what to do if the markets are not going in your favor, right? These are steps which people might find to be exhaustive and to be over, you know, over empowering, but please, these all steps are for your betterment. So if you're able to follow them, you are rest assured that yes, you will have more clarity when it comes to trading, correct? And of course, removing emotions, right? Because of course we are human beings, everyone has emotions, and we have our good phases when we are happy, ecstatic, joyful, and there are phases of our lives when we are sad, we are angry, we are in misery. So human beings are, they cannot live without emotions. We will always have a dynamic nature when it comes to emotions, but when it comes to trading, it is of vital importance that you keep your emotions outside, right? If you are trading, you need to keep your emotions outside the room. Wherever you are sitting at, wherever you are, emotions should not come. Yes, I understand it is easier said than done, but people need to understand, and it is of crucial importance. You cannot be having emotions when it comes to trading. Now, let me show you from an example point of view. We have trades that we have been providing to you and have been making and have been squared off, right? That's how we have generated profits. Now, all the way from 18th of September till 7th, over a span of 34 trades, we have been able to make such profits. At the same time, we have trades that are currently running. So when the trades were booked in profit, we were happy, we were joyful, we were like, wow, we have made money. But at the same time, we have certain trades that are, going unfortunately against us. Now when these trades are going against us, I am pretty sure a lot of you would be like, oh, it is getting very, I'm feeling very sad, I'm not feeling good, the markets are going against us. People, please understand, the markets are going to do what they have to do. We as analysts, we and you as investors can only take high probability trades and improvise as and how the market conditions are evolving. For trades that go into your favor, you feel happy, you feel aesthetic, you feel good, you feel joyful, correct, that you're making profit. At the same time, there are certain trades which are not going in our favor, right? Let me show it to you on TradingView itself. For example, if we look at Eventel, Eventel is a very good example because it just showcases how people should be attentive. Majority of you are doing a very good job, right? But I'm just trying to get it clear that people should be attending all our live streaming sessions, as well as taking trades the moment they are shared. The moment a hot stock is analyzed, we provide to you. Once a hot stock is provided to you, you just have to make sure that you are present in the live streaming session and you have kept your trading account open, right? This is during when the stock market is open. But like I was saying, a hot stock idea provided between 165 and 170 has already made a 5% profitability, right? So people who had entered at the earliest price, at the best price possible, have already made. So for people who made, let me show it to you with an arrow. For people who have made are happy, correct? For people who have made are happy, but for those who are who have not closed trades or who did not make profits, they are sad, right? So emotions are going to be a part and parcel of trading. Now, how well you can control your emotions, or how well you can numb those emotions, right? Numb as in, how well you can keep the emotions outside, correct? Because with emotions come bad decisions, right? When people are happy, they feel great. When people are sad, they feel bad, correct? So that is the reason it is always important to keep your emotions outside and focus on trading as a business, because you should be very clear in terms of where to enter, where to exit, what to do if prices are going in your favor, and what to do if prices are going against your favor. So I hope people are able to understand the crux of what I'm trying to explain, right? So please keep your emotions outside. Remove emotions from the equation, correct? I hope people had a great time learning the advanced technical analysis. Yes, there is never ending. When it comes to technical analysis, I can keep talking for hours and hours, but we want to keep it short, crisp, and to the point. So we had covered in terms of what FIIs are. We were talking about FIIs, we were talking about DIIs. Let me show it to you. We talked about FIIs, we talked about DIIs, we talked about stop loss hunting, we talked about market manipulation, how market makers, right? The FIs and DIIs have market makers who manipulate price, who skew or distort the prices and temporarily, and that's how people generally suffer from losses. We showed you illustrations in terms of how prices are moving. We showed you examples on the real charts in terms of how a typical stock, we were talking about black box, right? So how it stopped us out, it went in our favor, it stopped the people who were breakout traders, it stopped the people who were support and resistance traders. So it did a lot of manipulation. Then we talked about the key points to remember, and these are very, very vital when it comes to being aware of how trading works. It's not just about clicking the button and taking trades. It's about understanding the entire environment, the entire physiology of financial trading, right? And they are mainly certain points such as understanding the market before you enter, understanding and determining the market conditions from a fundamental analysis point of view and from a technical analysis point of view, assessing your risk, understanding your risk to reward, documenting your trading plan, right? The example that I gave you in terms of the commercial pilot, it is crucial. A commercial pilot cannot fly a plane until the entire checklist has been analyzed and observed. So similarly, before you even take a trade, you should also have your checklist, right, in terms of whatever variables you are willing to look at. And last but not the least, we looked at how important it is to remove emotions from the equation. The less emotions you bring to trading, the better your trading will become, right? We showed you, I showed you examples in terms of how we have been making very good profits. But yes, there are trades which are going against us. But we keep improvising, we keep updating you as in how the market conditions change, and we will let you know for any other details in terms of either adding positions or mitigating it via some other processes. So do not worry, we will keep you informed. So I hope everyone had a great time. I really enjoyed. I'm happy that I was able to showcase and share this vital information for you because it is very crucial, right? So I hope I'll see everyone in the next live streaming session, which will be tomorrow. Tomorrow will be Thursday, and we will also analyze how the markets have performed, what changes have taken place, so on and so forth. All right, so I wish everyone a very great evening, and I will see you tomorrow. All right, so until then, namaste and take care.